It's 8:47 on a Monday morning. You're sitting at your kitchen table. Coffee's still too hot to drink, and you've already checked your portfolio 3 times. The market's been open for 17 minutes, and somehow that little red number next to your stocks feels like a personal insult. You scroll through X, and everyone's screaming about the next big play. Some guy with a laser eye profile picture just 10x'd his account. Your cousin just texted you about a stock he's definitely not wrong about this time. And deep down, in a place you don't want to admit, you're wondering if you're actually bad at this. Look, here's the thing nobody's going to tell you in a tweet or a TikTok. The reason your portfolio feels like a roller coaster isn't because you picked the wrong stocks. It's not because the market's rigged. It's not because you didn't buy enough of whatever's trending this week. The real reason is much simpler and way more uncomfortable. You're not actually investing. You're drinking foam. And once you understand what that actually means, I promise you, you're never going to look at the stock market the same way again. My name is James, and I spend way too much time thinking about the mechanics of how the stock market actually works. If you're someone who checks your portfolio more times than your text messages, who panics when stocks drop and panics when they go up too fast, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because by the end of the next 20 minutes, you're going to have a tool in your head that most investors, even professional ones, completely ignore. And it's going to change how you think about every single stock you ever buy. So here's where this whole idea comes from. There's this financial writer named J.L. Collins. He wrote a book called The Simple Path to Wealth that's basically become the Bible for regular people who just want to stop losing sleep over money. And in that book, he uses this analogy, the beer and foam analogy, that is honestly one of the clearest explanations of the stock market I have ever come across. And the wild thing is, it's so simple, a 10-year-old could understand it. But somehow, Wall Street has spent the last 100 years making sure you never hear it. So let's break it down. Imagine you walk into a bar, and the bartender pours you a pint of beer in a tall, clear glass. You can see everything: the rich amber liquid, the crisp layer of foam on top, exactly how much of each you're getting. You look at that glass, and you know instantly what you're paying for. That's how simple investing should be. But it's not. Because in the real stock market, you don't get a clear glass. You get an opaque ceramic mug. You can't see inside it. You just get told a price. And you have to decide right there on the spot whether you're getting value or getting played. Here's what the beer actually represents. The beer is the real business. It's the sales, the expenses, the profits, the factories, the employees, the products people actually buy and use. When you buy a share of a company, you are literally buying a tiny piece of that beer. You own a fraction of the sales, a fraction of the buildings, a fraction of the future earnings. That's what you're really paying for, or at least that's what you should be paying for. The beer is boring. The beer doesn't move much from day to day. The beer is just, a solid, functioning business, doing its thing, making money, serving customers. Now let's talk about the foam. The foam is everything else. The foam is the hype. The foam is the vibes. The foam is the fact that someone famous just tweeted about a company. The foam is the guy on YouTube screaming that this stock is going to the moon. The foam is the fear of missing out when your friends are bragging about their gains. The foam is the panic when the market dips and you sell at a loss. The foam is, basically, every emotion that has nothing to do with the actual business.
And here's the kicker. The foam is what makes the stock price move up and down every single day. So when you look at a stock chart going crazy, what you're actually watching is the foam, not the beer. The business didn't change. Coca-Cola didn't sell a billion more cans of soda overnight because Jim Cramer screamed about it on TV. What changed was the foam, the perception, the emotion, the story people are telling themselves.
And here's where it gets really interesting. Because the stock price you see, that number on your screen, is always a mix of both beer and foam. But the problem is, you can't see how much of each you're buying. Remember, you're holding that opaque ceramic mug. It just says price on the side.
So sometimes you pay $20 for a stock and you're getting $19 of beer and $1 of foam. That's a bargain. That's how Warren Buffett built his fortune, by the way, finding mugs that were mostly beer. But other times you pay that same $20 and you're getting $2 of beer and $18 of foam. And here's the scary part. Foam evaporates. It's bubbles. It's air. It was never real to begin with. And when that foam disappears, and it always disappears eventually, you're left holding a mug that's basically empty. And now your stock is down 70%, and you're trying to figure out what the hell just happened. Let me give you some real examples of what foam looks like when it evaporates. Because this isn't just theory. This has happened over and over again, and it's going to happen again. In 1999, there was this thing called the dot-com bubble. Companies were adding .com to their names, and their stocks would double the next day. Businesses with zero revenue, zero profit, zero customers were valued at billions of dollars. There was a company called Pets.com that became famous for spending millions on a Super Bowl ad before they'd ever turned a profit. Total foam, no beer. And when the foam evaporated in 2000, trillions of dollars in market value disappeared in about 18 months. People lost their retirement savings, and they still ask, how did nobody see it coming? Everyone saw it coming. They just didn't want to stop drinking. Then there was 2008, the housing bubble. Banks were giving mortgages to people who couldn't afford them, bundling those mortgages into investment products and selling them with AAA ratings. The foam was the belief that housing prices would go up forever. The beer, the actual value of those houses and the ability of those people to pay back those loans was nowhere near as high as everyone pretended. When reality caught up, the foam evaporated, the whole global economy nearly collapsed, and people who were paying attention to the beer made fortunes betting against it. More recently, in 2021, we had the meme stock moment. GameStop, AMC, a bunch of dying retail companies suddenly had their stock prices shoot up hundreds, sometimes thousands of %. Not because the businesses got better, not because they sold more video games or movie tickets. The businesses were the same or worse. It was pure foam, pure internet-driven hype. And a lot of people made a lot of money on the way up, but a lot more people got absolutely wrecked on the way down because the foam evaporated like it always does. And then, of course, there's crypto, which I'm not going to touch too hard today, but you've seen the patterns. Moonshots, crashes, another moonshot, another crash. That's foam behavior. Now let me show you the other side, because it's not all doom. There are companies that are mostly beer, and over decades, they are quietly the greatest wealth-building machines on the planet. Take Coca-Cola. Boring, right? They sell sugar water. Been doing it for over 100 years. But that sugar water business generates massive, consistent, predictable profits every single quarter. The stock doesn't 10x in a month, but over 30 years, if you owned Coca-Cola and reinvested the dividends, you turn $10,000 into hundreds of thousands. That's beer. Real, measurable, repeatable beer. Look at Apple. People love to talk about Apple like it's a meme, but here's what's actually happening. Apple sells real products to real people who pay real money, and they do it with insane profit margins. Every iPhone, every MacBook, every pair of AirPods, that's beer. That's a real product leaving a real factory, going into a real person's hands in exchange for real money.
The foam on Apple stock goes up and down all the time, based on whatever quarterly rumor or analyst upgrade, but the beer, the actual business, has been growing steadily for decades. Costco is another great example. Costco is about as unglamorous as a business gets. They sell bulk toilet paper and rotisserie chickens. Their executives don't go on podcasts bragging about disrupting anything. They're just, quietly selling enormous amounts of stuff to loyal members year after year, decade after decade. But the beer on Costco is so solid, so consistent, that the stock has been one of the best long-term performers in American history. Not because of foam, because of beer. Notice a pattern here? The companies that build real, long-term wealth are almost never the exciting ones. They're the ones your grandmother would understand. They make products, they sell them. They keep a chunk of what they sell. That's it. That's the whole game. So here's the question. If the beer is what matters and the foam is just noise, why does everyone keep drinking the foam? Why can't people just focus on the business and ignore the hype? And this is where it gets uncomfortable, because the answer is your brain is literally wired to drink foam. And once you understand this, you're going to see it happening to yourself in real time. And it is honestly a little bit terrifying. There's a psychological thing called FOMO, fear of missing out. And your brain is wired to feel the pain of missing out way more intensely than the pleasure of winning. So when you see other people making money on a stock, your brain doesn't say, good for them. Your brain screams, you're losing. Even if you're not, you're just watching. But your brain doesn't care. It wants you to jump in because missing out feels like dying. And that's FOMO behavior. Then there's herd mentality. We're social animals. Evolution programmed us to stick with the crowd because the crowd was safer than being alone on the savannah. But in the stock market, the crowd is often wrong. The crowd bought in 1999. The crowd bought in 2007. The crowd bought GameStop at $400 a share. When you're doing what everyone else is doing, you're usually drinking foam. Then there's loss aversion. This is the thing where losing $100 hurts about twice as much as gaining $100 feels good. So when your stock is down, you can't sell, because selling means admitting the loss is real. So you hold and hold, hoping the foam comes back. And sometimes it does. Most of the time, it doesn't. And finally, recency bias. This is the big one. Whatever happened recently feels like it's going to happen next month. If a stock went up last month, your brain assumes it's going up next month. If crypto made someone rich last year, your brain assumes it's going to make you rich this year. But the market doesn't work like that. The market is cyclical. Foam comes and goes. Beer stays. And the really painful part is, by the time you actually notice a trend, you're usually late. By the time you're buying, the smart money is already selling. By the time you're selling, the smart money is already buying. That's how foam gets transferred from people who don't understand the game to people who do, over and over and over again.
Okay, so how do you actually read the beer? How do you look at a company and figure out how much of what you're buying is real versus bubbles? You don't need a finance degree for this. You just need to know a few things. First, revenue. Is the company actually selling stuff? A real business has real sales. If you can't find the revenue, or if the revenue is tiny compared to the stock price, you're probably staring at a glass of foam. Second, earnings. Revenue is great, but does the company actually keep any of it? Profit is what matters. A business that sells $1 billion worth of products but loses money every year, that's suspicious. That's foam dressed up as beer. Third, the PE ratio, price to earnings.
Sounds fancy, but here's what it actually means. It's basically how many years it would take at the current rate for the company's profits to add up to what you paid for the stock. A PE of 20 means 20 years. A PE of 100 means 100 years. When you see a stock with a PE of 500, what you're really seeing is a mug that's 98% foam. You'd have to wait 500 years at current earnings to get your money back. Fourth, free cash flow. This is the realest number in the whole game. It's the actual money the business generates after paying for everything. Profits can be fudged with accounting. Cash flow is much harder to fake. And fifth, debt. How much does the business owe? A company drowning in debt might look fine when the economy is good, but when the foam evaporates, debt is what kills businesses. You want companies whose beer is strong enough to stand on its own. Think of debt like this. 2 bars selling the same amount of beer a month. One owns their building and equipment outright. The other is leveraged to the eyeballs, paying massive interest every month just to stay open. Which one survives when the foot traffic slows down? Exactly. Same principle with stocks. Debt is the foundation that determines whether the beer keeps pouring during hard times or whether the whole operation collapses the minute things get tough.
None of this requires a spreadsheet or calculator. You can look all of this up on Yahoo Finance or Google in about 90 seconds. Type in the ticker, scroll down, and there it all is. Revenue, earnings, PE ratio, debt, cash flow. It's literally sitting there waiting for you. Most people just don't bother because foam is more exciting to talk about than beer. Foam makes for better tweets. Foam makes for better YouTube titles. Foam sells books and courses and newsletters. Beer just, makes you rich. Slowly. Over decades. And that's not sexy. But that's the whole point. Here's a statistic that should honestly terrify you. There's this research firm called Dalbar that's been studying investor behavior for over 30 years. And what they found is that the average investor underperforms the market by roughly 3 to 5% every single year. Doesn't sound like much, right? 3%? Who cares? Here's who cares. Over 30 years, that 3% gap means you end up with less than half the money you could have had. We're talking hundreds of thousands of dollars, sometimes millions. Gone. And why? Because most people are chasing foam, buying high, selling low, hopping from trend to trend, watching their portfolio instead of their life. So here's your action plan. 7 things you can start doing today and they cost you nothing. Number 1, stop obsessing over daily price movements. The price moves because of foam. The business barely changes day to day. Checking your portfolio 10 times a day is literally making you worse at investing. Delete the app from your phone if you have to. Number 2, focus on the business, not the ticker. Before you buy anything, ask yourself, do I understand what this company actually does? Do I understand how it makes money? If you can't explain the business to a 12-year-old, you shouldn't own it. Number 3, never pay a premium for pure foam. If a stock has doubled in a month and you can't point to a real business reason why, it's foam. It might keep going up. It might make someone rich, but that someone probably isn't going to be you. Number 4, when in doubt, index funds. This is the big one. Index funds are basically a premixed glass that contains a little piece of every major business in the country. The foam on individual stocks cancels out. You end up owning the average beer of the entire economy, which, historically, has been an extraordinary deal. J.L. Collins talks about this a lot, and honestly, for 95% of people, this is the answer.
Number 5, build a foam detector checklist. Before you buy any stock, ask, what's the PE? What's the revenue? What's the debt? Does this company actually make money? If you can't answer those questions, don't buy it. Period. Number 6, ignore the financial media. CNBC, X, Finance TikTok. Their job is not to make you rich. Their job is to keep you watching. And fear and excitement keep you watching, which is literally foam. The more you consume, the more foam you're drinking. Cut it down to maybe once a week if you have to check it all. Number 7, play decades, not days. The greatest investors in history didn't get rich trading. They got rich waiting. The beer compounds, slowly, silently, relentlessly. If you can hold quality businesses for 20, 30, 40 years, you will end up wealthy. That's not a promise. That's math. Here's a quick thought experiment before we wrap up. Imagine you walk back into that bar. The bartender slides a mug over to you and says, "That'll be $50. You pick it up. It's light. Suspiciously light. You peek inside. It's all foam. Maybe a teaspoon of actual beer at the bottom. Would you pay $50 for that? Of course not. You'd laugh. You'd walk out. You'd tell your friends about the scammy bartender. But that's exactly what most of us do in the stock market every single day. We hand over real money for mugs that are almost entirely foam. And then, when the foam evaporates, we blame the market. We blame the economy. We blame bad luck. But the mug was always mostly foam. We just didn't check. So the next time you're about to click buy on a stock, stop. Just stop for a second and ask yourself, am I buying beer or am I buying foam? Because that one question, asked honestly, will save you more money over your lifetime than every hot stock tip you will ever hear. Okay, before you close this video, I want to leave you with something real, a challenge. Because here's the thing, information without action is just entertainment. And I didn't make this video to entertain you. I made it to change how you invest. So here's what I'm asking. Take the next 30 days and do a foam detox. 30 days. That's it. And during those 30 days, you're going to do 3 things. Number 1, unfollow the noise. Every financial influencer, every hype account, every ticker-chasing YouTube channel, every Discord server screaming about the next big play. For 30 days, cut it all out. Your feed is currently a foam machine. We're shutting it off. Number 2, build what I call a beer-only watch list. Here's how you do it. Take a piece of paper or open a notes app and write down 5 to 10 companies, but not random ones. These have to be companies where you can clearly explain how they make money in one sentence. And when you look them up on Yahoo Finance, they have actual revenue, actual profits, reasonable debt, and a PE ratio that doesn't make you laugh. That's it. 5 to 10 real businesses. No meme stocks, no hype plays, no I feel like this one's going up, just beer. Write them down, put them somewhere you can see them. Number 3, for the next 30 days, every time you feel the urge to buy something outside that list, pause. Open your notes, read your beer list, ask yourself why you'd buy foam when you've already identified real beer. 9 times out of 10, that pause is going to save you from a bad decision. The 10th time, go ahead and buy. But now you're doing it with your eyes open, not because some guy on the internet told you to. That's the challenge. 30 days, no foam, just beer. And I promise you this, at the end of those 30 days, you're going to feel something most investors never feel in their entire lives. Calm, clear, in control. Because you're not chasing anymore. You're choosing. And that's the mental shift that separates people who build real wealth from people who just gamble in nicer clothes.
I'm telling you, the first week is going to be the hardest. Your brain is going to scream at you. You're going to feel like you're missing out on some huge move. That feeling is the foam leaving your system. Let it go. By week 2, the noise starts to fade. By week 3, you're thinking clearer than you have in years. By week 4, you genuinely don't care what the market did today. And that right there is what financial freedom actually feels like. Drop a comment with day 1 if you're taking the challenge. I want to see who's actually in. And if you make it to day 30, come back and tell me, because that's the moment your relationship with money changes forever. If this video helped you or shifted your outlook on how investing actually works, do me a favor. Share it with someone who's stuck drinking foam, because they probably don't even realize it. Hit that subscribe button if you want more videos that cut through the noise like this one. And remember, beer compounds, foam evaporates. Build wealth on the beer. I'll see you on the next one.